What would you do if you never had to work for money again? Would you travel? Start a passion project? Maybe sleep in every day? You can definitely do some of those things while you're still working, but let's be honest, you're probably limited by time and money. That's where financial independence comes into play. It gives you the freedom to live the life that you want. And today, I'm going to be sharing with you my plan to achieve it. If you're new here, hi, welcome. My name is Amanda, and I make videos documenting my journey to reach financial independence. In this video, I'm breaking down my exact plan, how I'm spending, investing, and designing a life where I don't have to rely on a traditional job. There's no fluff involved, no gimmicks, just real numbers, real steps, and my personal roadmap to making work optional. If you're not familiar with what financial independence is, it can mean different things to different people. To me, I think financial independence means you can live the lifestyle you want without having the need to work, and you have the freedom to choose what you want to do. So why do I want financial independence? To be completely honest, I don't think I found my true calling in terms of my career yet. That's not to say I don't like my current job, it just means that at the end of the day, if you need the money, a job is a means to an end. If you're able to enjoy it along the way, then I think that's a bonus. But if not, then you're basically just there for the money. Instead, I'd love to spend my time working on something I'm truly passionate about, whether it makes money or not. I prefer not to work for a company where I'm helping them line their pockets and they only care about their bottom line. In an ideal world, I sort of wish our lives didn't revolve around money so much, but the reality is that life does revolve around money and capitalism, which is exactly why pursuing financial independence is so important to me. It can give you the freedom to choose and work on your own terms. That being said, let's now go over my exact plan on how I'll be achieving financial independence. The first step is knowing how much you currently spend. This means tracking all of your expenses so you know your monthly and yearly spending amounts. This will also help you figure out how much you'll need to retire early if you choose to do so. There are several ways to track your expenses. You can do it for free on Google Sheets or Excel. I do have a tutorial with a free template if you want to check it out. I'll link it up here. Or if you want something more automated, you can use a paid app. Personally, my husband and I have been using Monarch Money for about a year now, and it's been super helpful for analyzing our spending together. For example, in 2023, we spent about $95,000, and in 2024, we spent $120,000. That averages out to around $107,500 per year. And now that we have our approximate yearly spend, we can calculate when we can retire early based on that spending amount. Using NetWorthify's early retirement calculator, you can plug in your annual income, your annual expenses, and your current portfolio values. Keep in mind that this calculator assumes that, number one, your current annual spendings equal your current annual expenses in retirement. So this means that whatever you're spending now on a yearly basis is what you'll be spending in retirement. Number two, you will never draw down on the principal. Your net worth will never shrink. Number three, current annual income is after taxes. And number four, annual return on investment is after taxes and inflation. Okay, so after plugging in our numbers, our current annual income is about $210,000 after taxes. And our expenses, as mentioned previously, it was $107,500 on average. And our current savings rate is about 48% after tax. And then we also entered our current portfolio value, which is about $507,000. So once you crunch the numbers, it says that we'll be able to retire in 13 years with a savings rate of about 48%. Obviously, the higher the savings rate, the faster we would be able to retire, but I'm not trying to speed run to retirement as much as I dislike working. It seems like a recipe for a burnout, which I'm trying to avoid as much as possible. Since this assumes that we will never draw down on the principal, we will most likely die with millions in the bank, which I'm not too sure about either. I've heard about the book Die with Zero a few times, which talks about literally making sure that you spend all your money before you die. But I think for now, we'll plan to keep our principal throughout retirement. But what if we want to spend more in retirement, or if we plan to have a baby, for example? This leads to the next step, which is knowing how much you want to spend in retirement. Do you want to maintain the same lifestyle, spend less, or maybe even spend more? So for example, if you want to spend 100K a year in retirement, you would need $2.5 million using the 4% rule, where you divide 100K by 0.04. If you want to spend 150K a year in retirement, then you would need about 3.75 million invested, and so on. But let's say you want to retire early. This 4% rule only works for 30 years, for example. So let's head over to ProjectionLab to simulate some different outcomes for our plan. Okay, so this is our accumulation phase plan, which is pretty similar to the one that we were looking at earlier on NetWorthify. So on NetWorthify, it said that we would be able to retire in 13 years, and given all our data inputs that we've already set up, ProjectionLab also predicts that we'll be able to retire in about 13 years from now in 2038. This is the accumulation phase only, but if we zoom out to our full plan, this plan assumes that we will live until 100 years old. Currently, this plan has a yearly expense of about $118,000 each year. And at the end of our plan, it's projected that we'll have about $25 million. But let's say we want to spend 50K more in retirement each year. So down here, I've added a extra 50K expense that I deactivated for now, but if I reactivate it, you'll see that the plan has shifted, and by the end of our plan, we'll still have about $12 million. But what's the success rate of this? This is obviously using an ideal situation, so let's run a Monte Carlo test to see how well it will do. Under chance of success, I can run a test here. So it's running some simulations, and the success rate is about 77.6%. But let's revert back to the original plan and compare the success rate. So back to the plan, I'm going to deactivate the extra 50K, and then let's see the chance of success now. Okay, so with the original plan, the success rate is 91.15%. As you can see, the more that you want to spend in retirement, the lower the success rate of your overall plan. This is also known as a sequence of risk. For example, drawing down during a bear market will most likely cost you more than drawing down during a bull market. Ideally, I would feel comfortable with a success rate of about 90% or more. So I think our current plan is pretty good for now. Some other possible scenarios could be that we want to plan to have a baby, so adding a baby expense here, I've made it so that they cost 20K a year for 20 years. And you can see that our financial independence goal, so back to the accumulation phase, has shifted a little bit by 2 years. So originally it was 2038. Now the retirement goal is set to 2040. What if we want to have a baby and, for example, I want to stay at home? So I stop working. I can also deactivate my salary here to see how that affects our plan. And you can see I think it extends it by additional 10 years from our original plan. Or what if I want to keep working? So I'll toggle my salary back, but we want to buy our dream home. And in order to do that, we would probably have to sell this home. So I can change it so that it's sold at the beginning. And if we sell our current home, buy our dream home now for $1 million, 200K down with a 5% interest rate, it would push our retirement goal all the way until 2050. As you can see, there are several factors that can impact your financial independence goal depending on what you plan on spending on throughout your life. I think it's important to simulate possible scenarios that might happen throughout your life, just so you're aware of how much it could cost. Going back to our original plan, if we want to retire in 13 years, we'll need to have an after-tax savings rate of about 49%, which is pretty similar to what NetWorthify also calculated. So in terms of contributions, every year we would be maxing out both of our 401ks and then also our Roth IRAs using the backdoor method. We would also contribute at least $30K to our taxable account. It should increase as our income increases, and about 5% allocated to crypto. And lastly, we also have our employer matching contribution, which helps out as well. All of these contributions are currently set up automatically from our accounts on a recurring basis. Some people might see this as the hardest part of having to get all your accounts set up, but I think it's the complete opposite. Once you have everything set up, the hard part is waiting. At least it is for me. The best thing you can do once you have everything set up is to just go on about your life and check back in every once in a while. The worst is constantly checking to see how much you are closer to financial independence, and it will feel like an eternity if you're not seeing that much progress from checking so frequently. I've been able to tone it down from checking every day to once a week to now checking only once a month. So as long as you have your system set up, you should be fine. So trust the process. The key is staying consistent by automating as much as possible, avoiding lifestyle inflation, and making sure your money is working for you. At the end of the day, I think everyone wants to reach financial independence in some form. The journey will look different for everyone depending on timing and how you choose to get there. But the most important part, one that's really easy to overlook, is finding balance. So you should enjoy life now to a certain extent while also being able to save for the future. I think people usually get hung up on one extreme of either living so frugally that when you do reach your retirement goals that you don't even know how to spend your money, or on the flip side, constantly overspending and not having any retirement savings for your future self. I think the last key is finding that sweet spot where you can do both, being able to spend money now and in the future. As a final note, I don't think we'll end up fully retiring even if we do reach financial independence. I think it'll be more about working on things on our terms and having the freedom to do so. I'd love to hear about your thoughts on financial independence in the comments down below. If you enjoyed this video, please give it a like and hit that subscribe button to follow along in our journey. Thank you so much for watching, and I will see you in the next one. Bye-bye!